Podcast Episode 2, Types of Businesses. Welcome to today's episode, where we dive deep into one of the most crucial decisions every entrepreneur faces: choosing the right business structure. Your business structure shapes your taxes, liability, and growth potential. In this episode, I'll break down 6 major business structures with exclusive insights and real-world examples to help you make smarter decisions for your venture. Let's get started. Got it. Here's segment 1. Business structures with even more exclusive insights, advanced details, and real-world examples. Segment 1. Business structures. Choosing the right business structure is one of the most important decisions for any entrepreneur. It affects taxation, liability, funding options, and operational flexibility. Here are 6 key business structures with exclusive insights and examples. 1. Sole proprietorship. Definition: a business owned and operated by one person. Liability: the owner is personally responsible for all debts. Taxes: profits are taxed as personal income. Pros: check easiest and cheapest to start. Full control over business decisions. Minimal paperwork and legal requirements. Cons: unlimited liability. Personal assets can be used to pay business debts. Harder to raise capital. No stock options or investors. Limited scalability. Business is tied to the owner's capacity. Exclusive insights: many successful businesses started as sole proprietorships. Example: Jeff Bezos started Amazon as a small online bookstore before incorporating it. Sole proprietors often transition to LCLs as they grow to protect personal assets. Second partnership. Definition: a business owned by 2 or more people. Types: general partnership, GP. All partners share management and liabilities. Limited partnership, LP. Some partners invest but don't manage daily operations. Limited liability partnership, LLP. Protects each partner from the other's mistakes. Pros: more capital and shared responsibility. Easier to start than corporations. Flexible structure with different partnership types. Cons: shared liability. Partners can be held responsible for each other's actions except in LLPs. Potential conflicts over decision-making and profit sharing. Harder to transfer ownership. Exclusive insights: many law firms and medical practices use LLPs to protect individual partners. Example: Deloitte, a major consulting firm, operates as an LLP. Partnerships can lead to large corporations. Example: Warner Brothers started as a small partnership among 4 brothers before becoming a global entertainment giant. Third corporation: C Corp and S Corp. Definition: a separate legal entity that limits owner liability. Liability: shareholders are not personally responsible for debts. Taxes: C Corp pays corporate taxes, plus shareholders pay personal taxes, double taxation. S Corp avoids double taxation but has restrictions on ownership. Pros: owners have limited liability, personal assets are protected, easier to attract investors and raise large amounts of capital. Perpetual existence: business continues even if owners change. Cons: expensive and complex to set up. More government regulations and reporting requirements. C Corp face double taxation. Exclusive insights: most major corporations started as smaller business structures before incorporating. Example: Facebook started as an LLC before converting to a CCORP to attract investors. Corporations often use Delaware incorporation for tax benefits. Over 60% of Fortune 500 companies are registered in Delaware due to favorable corporate laws. 4. Limited liability company, LLC. Definition: a hybrid structure combining benefits of sole proprietorships and corporations. Liability: owners, members, have limited liability. Taxes can be taxed as a sole proprietorship, partnership, or corporation. Pros: limited liability without the complexity of corporations. Pass-through taxation. Profits are taxed as personal income. Fewer regulations than corporations. Cons: varying rules depending on state or country. Higher self-employment taxes than corporations. Limited ability to raise capital compared to corporations. Exclusive insights. LLCs are the most popular business structure for small and online businesses. Example: many Amazon FBA sellers register as LLCs to protect personal assets. Big brands also use LLCs within their corporate structure. Example: Google's parent company, Alphabet, has multiple LLC subsidiaries to manage different business divisions. 5. Cooperative. Co-op. Definition: a business owned and operated by its members who share profits and decision-making. Liability: limited liability for members. Taxes: varies, often taxed at lower rates. Pros: check members have equal say in decisions. Profits are shared among members, not external investors. Strong community-driven model. Cons: decision-making can be slow due to democratic process. Harder to attract external investment. Exclusive insights: some of the biggest co-ops generate billions in revenue. Example: REI, Recreational Equipment Inc., operates as a consumer cooperative, sharing profits with members. Coops are common in agriculture and utilities. Example: Ocean Spray, a cranberry juice brand, is a farmer-owned cooperative. 6th, franchise. Definition: a business model where a company, franchisor, licenses its brand, products, and operations to independent owners, franchisees. Liability depends on the franchise agreement. Taxes: franchisees pay fees to the franchisor but operate as independent businesses. Pros: lower risk. Franchisees follow a proven business model, brand recognition, and built-in customer base. Support from the franchisor, training, marketing, supply chain. Cons: high startup costs, franchise fees, royalties, and operational costs. Less independence. Franchisees must follow strict rules. Revenue sharing. Franchisees pay ongoing fees to the franchisor. Exclusive insights: franchises account for over $670 billion in the U.S. economy. Example: McDonald's is the world's largest franchise, but 93% of locations are independently owned. Not all franchises operate the same way. Example: Chick-fil-A doesn't sell full franchises. Instead, it allows operators to run locations under strict company oversight. Key takeaways from business structures. Sole proprietorships are best for freelancers and small businesses. Partnerships work well for professional firms like law or accounting firms. Corporations are ideal for high-growth startups looking for investor funding. LLCs offer flexibility and liability protection for small business owners. Co-ops benefit community-driven businesses. Franchises are a great way to start with a proven business model but require capital and compliance. Closing call. Choosing the right business structure can define your success. Whether you're just starting or looking to scale, understanding these options is key. If you found this helpful, don't forget to like, follow, and subscribe for more actionable insights on building a thriving business. Have questions or need advice on structuring your business? Drop them in the comments. See you in the next episode.